we move on to our next slide, and this is a bit of a segue into the commercial matters of considerations for going public. And I think that many of us in business, when we have aspirations of growing our business, this goal of going public sounds very exciting. And I ask the question, firstly, why? Why do you want to go public? And if you're going to go public, it must be for the capital, not for the ego. We see many listed companies where the founders still control 75% of the company. To my mind, that is not a listed company because there is no liquidity. Who would buy shares in a company that's so thinly traded? And so you need to think about what is your rationale, why are you going public, right? And the answer often comes to me, because I want to raise capital. There's a very interesting question that comes after that, and can you guess what it is? What are you going to do with it? Often the desire to raise capital, right, is not backed by a clear business plan, and is not even sometimes backed by how much you want to raise. And so the key in this situation is understanding what your plan is. Now, I ask the question, should you consider alternatives? Right, equity can be a very expensive form of capital raising, and while I think it is a wonderful form of capital raising, it's not the only form. Is debt a possibility, either debt through banks or debt through high net worth individuals, or what I describe as the 3 Fs, that is friends, family and fools that might put money in. The second is private equity, and the third is venture capital, and the fourth might be a JV to achieve your goals. So going back to my initial point, what are your plans and aspirations? What is your business plan? And how are you going to achieve it? The other question, of course, is are you profitable enough? There needs to be a core of profitability before you should even dream of going public. And I can't make a comment specifically and won't in terms of what it means here in the Indian market, but if your profits are not in the millions of US dollars, then it's hardly worthwhile going public. You've also got to deal with the issue of dilution, and that is you won't own 100% of the business if you do go public. So what are you prepared to give up, and how much are you prepared to give up to trade off a future that is much bigger than before? My experiences in being a minority shareholder in an enormously growing business have been absolutely fantastic, where diluted to 5%, my reward when the business was finally sold was significantly greater, in a factor of multiples of 1,000 from the initial capital that was put in. So the journey is a wonderful opportunity if you understand what you're doing. You must have a compelling growth proposition. If people are going to invest in you, you need to have a well-developed business already with a growth trajectory, with at least the last 52 weeks hitting budget to your business plan before you should even consider raising capital or going public. You also need to have a very clear plan of how the shareholders, your new partners, are going to get a return on the capital they put in, and a return and a multiple return on the risk that they will take. So a compelling growth proposition is critical. You also need to consider your board and your management and your chairman. We find that closely held businesses where the mother, the father and the son and the daughter are all the executives, directors and chairmen are not very attractive to investors. So you need to be big enough to consider having independent directors on your board and an independent shareholder. so that independent chairman, so that shareholders' issues are taken care of. You also need to get good advisors and understand your costs. I would say in the West, you're probably going to spend somewhere between $500 and $1 million to get a company up and floated. And so you need to have not only that cash flow and profitability, but the desire to actually invest that. And if you're going to get advisors that have got a track record in your industry and have already done this many times. Don't get advice from a learner. Ongoing compliance is also an issue. You'll have a full-time officer, probably the right-hand man of your CFO, if not your CFO, who'll be full-time involved in complying with public company requirements and reporting and disclosure. So understand that your costs are going to rise to meet that compliance, and ultimately you need to understand that you have to manage your shareholders. They put their cash into your business, and so you need a strategy to manage your shareholders and communicate with them on a regular basis, as well as communicating with the stock exchange. So with that, I might have you address some of these legal issues associated with floating.
Yeah, I think it's true that I think considerations going public, it's just not about capital raising. It's one part, and it's not about ego, of course. You don't want to say we are public, and therefore that's not something and in itself. In fact, we had a lot of experience, particularly on the US side, taking Indian companies public, such as Infosys, we listed on NASDAQ, or Wipro on New York Stock Exchange, and other ones. If you look at the underlying theme, is to give value to the shareholders. And for example, even when we took Infosys, it didn't need capital. You must be aware that it's almost always has tried to be debt-free company. They could have grown with taking debt. But the whole idea was to create a brand. And something must be left on the table for the investor who comes in. That's the theory. And so it is not about ego, it's not about just, today it is even more onerous to go public, because if one of the chairmen of the top multinational companies told me that almost 60 to 70% of the time they spend is on investor relationship. Okay? Now you can spend the same time on doing your business. Okay? And so it's not always necessarily the best thing, but it is situational, and I'm not discouraging you from looking at that. Indian companies, recently Coffee Day and some other ones have already come up. So there are models, but it's very important to look at first alternate capital, what you have mentioned, the second part. And today there is a lot of VC kind of investment available. All that you need to do is to have a good business model, and more important than anything else, people smell your team. That's the most important part, as you already mentioned to some extent, the management side of the. So is the management honest? You can show profit, people will not give you valuation, guaranteed. If they smell that there is a right in the management, okay? But if you're making consistent loss, you can make bigger and you can get bigger and bigger valuation. That's what we do in the US, in Silicon Valley. More losses you have, we never say we made losses. We say we are in investment years. And more losses you have, all these companies have bigger valuation. So I think there is an art of making loss, but these are all actually building blocks. And it's very important how you present and your case and go about. But I would normally recommend people to look at the alternate capital first, subject of course to your third point about dilution. Because you do not want to dilute so much that you lose control, and therefore you lose control for the sake of control. Again, is not necessarily an important thing. Control for the sake of maintaining quality, quality of the product, quality of the management, quality of culture, and those are the kind of things you really want to do. So as I said, control is a tool. It's not an end in itself. Again, so that's very, very important. And even these days, even the board directorship is very onerous. I'm not taking up any board seat any longer, simply because in India particularly it has become very onerous. So when do you become director? When you take up directorship? Only when you can devote enough amount of time and attention, then get in. Otherwise, don't get into the board just for the sake of getting some ego boosting, as you say, or something like that. And one of the other ways, in the initial period, you might want to consider your model to be built around LLP. Now, government has allowed LLP structure to come in, which is slightly less onerous in terms of compliances. Yes, there are some issues, but on the whole, that is a new structure that has been coming up, and one might want to consider that. So, so that's the thing. And of course, the compliance has become, again, very onerous. A number of things that you have to do every morning, new regulations come in. So I can understand that where you come from. And I already made a mention that shareholder communication. And again, in your particular case, communication with your franchisor, if you are a franchisee, and communicator as a franchisor to your franchisee other way around. Both ways, communication flow is very critical. I think we are running short of time. I'm talking as a lawyer. We normally charge for speaking and also for hearing. But for the time being, I'll stop. Ananth, you have a word to say very quickly?
Yeah, just very quickly on compliance. What companies should know is it's very important that they document transactions and commercial justification for transactions, because this is what will demonstrate the bona fides of your transaction and the reason why you took a particular decision. And straight off, I can reiterate, one is anti-competitive practices. No one would have thought that a franchisor's agreement will be vetted by the Competition Authority of India. But today, it is subject to the scrutiny of the Competition Commission. And similarly, again, for taxes, because today we have multiple taxes. We have VAT levied at the state level. We have service tax levied by the central government. So to ensure that there is no duplication and cascading effect of taxes, it's very important that these transactions be effectively documented. The third is criminal action. What we have seen in the last couple of years is people have realized that by filing a criminal complaint against a business party, you're able to bring them down to the negotiating table. And the other thing is, you have an FIR registered and you make directors liable. And police officers, sometimes without applying their mind, they mechanically add the names of directors as accused. So it's very important for companies, for franchisors particularly, and franchisees equally, I guess, to ensure that directors and key management persons, they are adequately protected, and you do that through documentation and constant review. And so that really goes to the point which Rod made, which is compliance, compliance, and compliance.
Thank you. I've just been informed that the Minister has arrived, and we don't want to have the engine of government slowed. So I'm just going to show you a little of the next few slides and then call for questions. And these slides will be available. Our emails are on the last slide. But we're looking at franchise renewals. It's a big issue and you'll need to consider this. And if we move on to the next slide, brand and culture considerations in legal fallout. Culture is a very, very important part of managing the way your relationships with franchise owners are, and there are some very good points that you can download or email to me and the team here to get that information. The issues are about control of collateral and monitoring social media and investing in PR and investing in your culture, especially to control learning and upskilling. So there's some key points here, and I'm sorry I've got to run through those. And brand and innovation and entrepreneurship all go together. And it's very, very critical that you understand the link between innovation and the need for your brand to innovate in order to survive.